Hi, I'm Jim Cunningham. I'm here with Chris Mann. We are going to talk about mid-year 2021 tax planning, what to do right now. As we record this, it is June 10th. And so we are coming up on the midpoint of the year. Many of our wealthier clients start thinking about taxes this year. And there's a lot of quirky stuff happening in 2021 that I think deserves some special attention. And disclosure, I'm a lawyer. Chris is a CPA. This is not legal advice. This is not tax advice. Don't take it as such. This is merely information only. Just because I'm an attorney and my lips are moving and words are coming out of my mouth, and just because Chris Mann, who has yet to say a word because I'm doing all the talking, but just because he's talking, it's just information only. Subscribe to our YouTube page if you haven't done so already, and stay abreast of a lot of great content this year. And Chris, you and I, our firms work together. I'm a lawyer and we're a law firm, and you're a CPA. We have each of 25, 30 years experience. We find that most people want to pay less taxes whenever possible while securing a legacy for their family. We're here to help you, give you some options, craft a plan, make a recommendation that is part of an integrated tax plan. And this leads to more wealth for yourself, your family, and your loved ones. Chris, in preparing for this, I think a lot of people make a mistake that April 15 rolls around and they say, hey, can I do some tax planning for last year? I don't think people pay enough attention to this. Any thoughts on this?
Yeah, I mean, I think, thanks for having me, Jim. I think that it's definitely something it's one of those things where it's not a great subject. Who the heck wants to deal with taxes on a regular basis? You got a lot of other things. We're all busy. We got a lot of things going on. So it's kind of one of those things like going to the dentist. You need to get your teeth cleaned, but you kind of put it off at times. And it's the same thing with this. So we have to be the ones that drive that to make sure that people are doing it. And we were just talking earlier that in today's world, with all that's going on with the changes, with the potential changes coming up and when they're going to be, whether they're going to be 2022 or the retroactive to 2021, it's going to be more important than ever for planning to be done, maybe not even just once. Like most of our clients that we work with, at least we do it one time a year, usually late summer, early fall-ish type thing, because enough of the years gone by in a normal year. This is not a normal year. And last year wasn't a normal year either. And so it's going to mean that you're going to have to do this more often, and we're going to have to keep everybody up to date on what's going on too, because we could see some changes coming as early as later this summer. We don't know what they are yet. We just hear things. Everybody's hearing different things. We get calls all the time and emails. What if he does this? What if he did? We don't know. I mean, it's like all this stuff is just like conjecture whether they're going to do something or not. They're going to do something. It's guaranteed there'll be change. Oh, yeah. But we know that, but we just don't know which ones are going to be the changes and which ones aren't going to be the changes. But it's going to be so important to do the planning in a lot of areas, not only with income tax, but also with estate planning and stuff like that, because that's going to be potentially a big change as well. So it's going to be very important to stay to it. I know everybody's busy, got a lot going on, and it's our job also to really keep pushing that this is important and it needs to be done.
Yeah, so we have a few questions here already. I want to start with these because this is directly tied to what we're going to be talking about. Patty asks, we're going to sell 2 rental investment properties and will not be doing a 1031 exchange on either. I know it's hard to predict, but would we be better off from a tax perspective selling both properties in 2021 or do one in 2021 and one in 2022? I think the answer to that is we don't know, Chris, right?
Yeah, we don't know, but I think a lot of that stuff like that, in my opinion, has more than just taxes involved. It's like, is this a good time to sell? The market's on fire right now. And,
right.
What's going on here. We know what we have today. So, the tax rate's what it is today. And it's very favorable on real estate sales, especially if you held it longer than a year, which I'm assuming you have. So to me, it's like, if you're looking to sell it anyway, and you take taxes out of the mix completely, then you make your decision and then the taxes will just take care of itself. But 2022, if it's, the way they're talking about it is if the capital gains under $1 million in total, then you're probably not going to have a difference between 21 and 22. But if it's more than that, then you got some issues potentially in 2022 if that bill, if that part of it passes.
Yeah, but again, we don't know. Anonymous asks, can you transfer an investment account into an LLC and have the income distributed to the beneficiaries? I would say yes. I mean, that's yes, maybe depending on the structure. That's something we could certainly talk to you about. If you have capital gains realized on March 26th, Will the proposed capital gains tax of 39.7 imposed if you have income exceeding $1 million? I think what they're asking is, will it be retroactive? We're going to talk about that. I think not to March 26th if it's retroactive, but because Biden's budget presumes a higher capital gains tax rate commencing April 1st. So you might have made it in, just slid it in under the radar perhaps. And then Mohammed asked, procedure to take out IRA to a Roth. That's a Roth conversion. That's something that's done with your financial institution. That's the mechanism to do it. How much you should do and whether you should do it is really, that's where a person like Chris, a CPA, myself, the lawyer, and the financial advisor get involved. And we all kind of have a powwow with the client and we figure out what's best for the client, given a lot of factors. So let's, these are the topics we're going to cover today. For those of you on the phone, are the tax increases going to be retroactive? That's a big question. What about PPP forgiveness, the Paycheck Protection Program? There's a federal and state issue. What about accelerating income from 2022 to 2021? So if you have the option of taking income in 2021 or 2022, should you take that income this year rather than next year? Is the 1031 going away? The benefits of an S Corp, if you're a business owner, this is super important, guys. This is kind of a no-brainer. This is about basic tax hygiene, for lack of a better term. We'll discuss Roth conversions and then the death tax increase. Chris, as you said, I think tax increases are likely. I think they're likely to be effective in 2022, but they can be effective the date that the bill is introduced in the House of Representatives. So that's the operative date. I've been following what the Treasury Secretary Janet Yellen has been saying, Chris. She says expect a spending bill in the spring, which we had, and a tax bill in the fall, which is September 21st. Any thoughts on if anything's going to get done this summer?
I don't think so, because it's hard to get stuff done. Right now, they're working on the infrastructure bill. And so they're getting that. And then there's a lot of issues with that. So I think that's going to take them up to the summer, and then they take a vacation into the Labor Day time. And then after that, I think is when they'll get to the taxes. That's what they did in 2017 when Trump took over, is they didn't get this going till the fall of 2017. That's why the bill didn't pass till December of 2017. And then everything got pushed into 2018, except for a couple minor things. Well, one of them wasn't so minor. The mortgage interest deal got retroactive to December 2017, but everything else got pushed to 1/1 of 2018, and which I think is going to end up being the case here, just because administratively, I think it's very difficult for the IRS to pull off a retro deal. And I think that's going to be difficult, even though Biden wants to do it. It doesn't mean he gets that, because he's got to deal with Congress and all that. And you got a bunch of people running for re-election next year. So I do think for sure on your list, taxes are going up. I guarantee for most people that are over 400,000, I can pretty much say for sure that's going to happen in a lot of different ways. Not only the rates, there's going to be a few other things that are going to happen that are going to make it, everybody's going to pay more if you're over 400,000. If you're under 400,000, maybe not so much. I wouldn't be that losing much sleep over tax increases if you're under 400, unless they pull the rug out from under everyone and don't follow what they said they were going to do.
Well, Anonymous asks, and this is a good point, and this is something that I think is on everyone's mind. If somebody makes over $1 million, I'm assuming earned income, is the capital gains tax rate 39.7 on all capital gain, or is the 39.7 on top on capital gains over $1 million? I'm trying to discern, is the threshold income, or is it on the amount of the capital gain? So the question is, if I have $1 million in capital gain and $1 million in income, which rates apply where? If you can just unpack that for us, Chris.
Yeah, I think in that scenario, you're going to have the full capital gains going to be at 39.6.
Yeah.
But I think if you pull out the other part and just say, I have a capital gain of $2 million, but I have no other income at all, I think the first $1 million maybe would be taxed at the lower rate, and then the second $1 million would be taxed at the higher rate. And I'm just, thinking that's how they've done stuff in the past with things like that. But it doesn't mean, because when we've had different rates on capital gains, we actually still do right now. We have a 0% rate, then we have a 15% rate and a 20% rate. So I can see them doing that based on how much income you make. So I can see that being like, the first $1 million would be at the 20%, and then the other would be at the 39.6 in that example. But again, we don't know for sure, but that's what I think would be the way they do it.
Well, in 2017, the Trump tax plan was retroactive on this mortgage loan interest. There is precedent for retroactivity. I personally think it's unlikely, and I think most people think it's unlikely. Turning to PPP loans and PPP forgiveness, Terry asks for PPP for PPP forgiveness round 2. Do we use the same reference dates to compare as with round 1? I don't see much guidance on round 2 forgiveness. I believe it's still 24 weeks. I believe
It is.
that right.
You can pick either 8 or 24, but I don't see any reason to do 8. I mean, there might be a few cases that are exceptions to do it, but the 24-week, the key with the PPP loans and the employer retention credits, if you qualify for those, especially for 2020, is to make sure that you're not using the same payroll to cover both things. And some people have gone in and done the forgiveness too early, in my opinion, and then they missed out on getting the ERTC credit, the employer retention credits, because most people in California could make a claim that even though they weren't maybe down 50% in income from 2019, they were partially or fully shut down for at least a period of time. I mean, almost all of us had some shutdown. Yeah. And so even if you took a 2 or 3 week period, like we just did a case where the client was closed for only 2.5 weeks. They're essential business, but basically over here, they said that you had to shut down. Everyone was just basically stay at home for like 2-3 weeks, even though the people were essential. So just with the 3 weeks out, they're getting a credit of like $260,000. Wow. Just from that. I mean, just from being shut down for 3 weeks because that payroll, they kept paying their people, and they're going to get $260,000 back. So this is big time stuff there. If you looked at it and say, I was partially shut down, and there's hardly any of us can say that we weren't, at least partially shut down in 2020. Now, 2021 is more of just a revenue deal. You go by quarter, you look at the first quarter of 21 versus the first quarter of 19. And if you're down more than 20% in your gross, you qualify for the PPP, the ERTC credits that are $7,000 per employee. And if you get it for the first quarter, you automatically get it for the second quarter, even if you're not down. So
yeah, that's really, you know what, I think this is highlighting the kind of the key takeaway on the PPP forgiveness and anything kind of related to this COVID federal relief and all this basket of tax benefits. This is not a DIY project. This is absolutely not a do-it-yourself project. And if you're the kind of person who does their own stuff all the time, I'm telling you, I live in this space professionally. And I'm using Chris's firm, and we're working together on our own stuff, right? Because this is not something you can figure out on your own. Especially if you're a layperson and don't have a background in law or accounting or whatever it is. The other really big issue is what about, I'm in California. Are the PPP loans forgivable? PPP 1 and 2, are they forgivable for California? Now, it's my understanding, Chris, that if you qualified for PPP 2, that generally speaking, your PPP 1 is forgiven for California state income tax purposes. But I mean, I've had some people file, in my opinion, prematurely their tax returns because they filed when it was uncertain, when the law was uncertain about whether PPP 1 was forgivable, was taxable as income in California. If you can maybe talk a little bit about how California is taxing the PPP forgiveness.
Yeah, what California did with PPP 1 is they said they just did this like May, I don't know, 7th or 8th or something. It was very late in the game, and we were waiting around for them to make their decision. And there was a lot of reasons. It wasn't all their fault. The federal government didn't help either with some of the things they did, but because they had a bill to get this all forgiven or all tax free a couple months prior, but the federal government stopped them from passing it for a lot of reasons. But when they finally got around to passing it, they put a little glitch in the thing, which said what you just said. Unless you qualify for the PPP 2, meaning you had to be down in the first 3 quarters of 2020 by more than 25%, your gross revenues over same quarter in 19, we're not going to let you have it tax free. You can get it, but you got to pay taxes on it to California. So there's going to be some people where the PPP loan is taxable, and others where it's not. And I don't think that was the right thing to do. Our industry sent as a matter of fact, I sent a letter to the assembly, the woman who crafted the bill, and said, this is why I don't think this is fair, because I saw instances where businesses would do things to keep their business going and keep cash flow going and paying people, but they weren't making any money. They were doing other things and adjusting their businesses so that they could stay open to keep people employed, which was the reason why the PPP existed. but they weren't, their profit margins were zero or a loss. And that didn't make sense to me, but their gross stayed high. And so they didn't meet the requirements. So now they got to pay taxes on it to the state. Whereas another business that maybe is profitable, but their gross was down, they get it tax free. So it's not, I mean, nothing's ever fair in this world. We all know that. But the thing is that I don't think that was the best way to do that. And our industry tried to do what we can to knock this, to knock that provision out and just give it free to everyone, but they didn't listen. And so that's where we are. PPP2, they haven't said what they're going to do yet on that. I don't know what they're going to do. So the way I understand it is this only applies to PPP1. Right now, PPP2, unless there's been something recent that I haven't seen, is taxable to everyone in California so far, but they may come up with something similarly to decide who's going to pay taxes on it and who isn't. So right now we don't know what's going on with PPP2, but PPP1, if you pay taxes on it already because you filed your return early and you qualified for PPP2, you didn't have to take it, just mean you qualified for it. Then you got to go back and amend your tax returns for showing that PPP1 is not a taxable event for you in California. So there'll be quite a few amended returns, I'm sure.
Yeah, so that's really important. If you guys did file if you did receive PPP1 and filed your return before there was clarity, which some people did, you might want to consider looking at your filing an amended return. Is there a bill moving the IRA RMD age to 75? Is there a chatter for completely abolishing RMDs till death? Anonymous, there were no RMDs until the 80s. I have heard something about moving the RMD to 75. Have you heard anything on that, Chris?
Yeah, I just was reading something about that this morning. It actually would be in stages to 75 is the bill I saw. And that's the House version, I believe. Maybe the Senate version is different, but the House version has it going to 72 right away. And then I think another year or two down the road, it goes to 73. And then by 2032, I think was the date, it goes to 75. So it's a stepped deal that was what they're proposing. It's not passed yet, but it's in Congress right now. Whispers.
Okay.
Yeah.
Should people consider, if you have the option of moving income from 2022 to 2021? So this is the initial question of, should we sell both properties this year or sell one this year, sell one next year? I agree with you, Chris. There are many reasons other than taxes to do things. And I think sometimes people put the tax issue ahead of other issues. And I think you need to have a balance. But how does this make sense? And when should you start looking at this? I mean, is this something that people should be looking at now, or can they wait? I mean, you obviously can't wait until 2022. Should you wait till the fourth quarter? Where do you think is kind of a safe zone if you have that option?
Well, it depends on what you got going on. If it's going to be straight, ordinary income from your business, or it's that type of thing, and you have control over that stuff, I think you want to move a lot of it to 21, not only because the rate's going to go up to 39.6. I think some people are going to lose what's called the Section 199A deduction, which basically is given business owners, most business owners, some don't get it, but most of them do, a 20% deduction on their gross income, or the net income. So let's say if you make $1 million of profit in your business right now in the current law, you get to take $200,000 off the top for federal taxes and not tax it at 37%.
That saves $70,000. It's a lot of money. 75
grand. Yeah. So it's a big deal. That's bigger than moving the 37 to 39.6, in my opinion, for most people. But so you're going to have that hit, the 2.6% increase, plus you're going to maybe lose the 199A. Now they're talking about only having the 199A go away for people over 400,000. That seems to be the magic number. So if you're under 400, you probably don't have to worry about 199A going away. You'll still get the deduction. But if you're over that, then it's going to be a big hit to wait to move stuff to 2022. So I think you go with what you know. And we know the tax rate for 2021 is where we are with things. In 2022, we don't know. So I would just keep moving along. And, if you can put more stuff, don't. A lot of times at the end of the year, people try to pay for things and stuff like that to try to reduce their tax bill. I'm not sure we do that this year.
Yeah, you might want to buy that truck in January, not in December.
Yeah, I mean,
right?
I don't know if December is the right time for any of that right now, or November, December. I think it's going to be early next year.
I see there was it looks like they're trying to put together a global minimum corporate tax of 15%. It looks like the G7 is kind of on board with that. They're talking about a corporate tax increase from 21 to 28%. I've heard it might land at like 25, 26. Is that going to negatively impact stocks? I mean, if corporations have to pay more taxes, what do they actually do? Do they end up paying the tax, or do they buy solar credits and whatever? I mean, what do these big corporations do? What do you see?
Well, I think some do. I mean, they have to pay the tax. They do get the money from them. It's a pretty big chunk that they get. I read that, I can't remember what the number is, but it's a significant amount to go from 21 to 28. So there is a lot of corporations paying. There's a lot that get these credits, but they're still paying tax right now. And that minimum tax is only if you're a company that's doing stuff overseas, not really. I don't think that really necessarily applies for stuff that's here, but that 21 to 28% usually doesn't affect a lot of smaller companies, because most companies aren't set up as a C corporation. Most of them are set up as an S corporation, because there's more benefits to being an S corporation. And I still think there is. And I think if they do some things the way that I think they're going to do with the Social Security tax, it's going to even be more beneficial to be an S corporation anyway. So
yeah, we're going to get to that.
Rate,
the reason I mentioned the corporate tax is more for investment portfolio.
Yeah,
purposes,
I think it will certainly affect things, but I think the stock market is building some of that stuff already in. And that's why the people I've talked to recently, the stock market, Wall Street seem to think capital gains may not end up being as draconian as going to 39.6 over a million, but who knows? But if they're wrong, then the market, I think, will see some crazy stuff happen in the last 3 or 4 months of the year. If that does happen, because I don't think they're expecting that right now.
This is bananas. This 39.6, because then you add on the Medicare, and then you add on California state. So capital gains over $1 million taxed at 56.7%. Now, I will tell you, in socialist countries, the government owns the means of production. In fascist countries, they take more than 50%. So to me, just intellectually going over 50% is hugely problematic, just as a human being, where the government's getting more than the taxpayers getting. I have no idea if this is likely. Do you think this is likely, or is this just so over the top? It's like, you got to be kidding me.
I don't think Wall Street's expecting it. Let's put it that way. I think they're expecting an increase from 20% to 25%. I think that's kind of what a lot of people think is going to happen. But who knows? In this, where we are in this world, everything's, I don't think you can count on until we're not going to really know. I don't think how this is going to shake out until more like Labor Day or after.
Yeah.
So we really see what the bill is on the House side, the Senate bill, and then they put them together and they kind of reconcile from there. And and there's gonna be a lot of horse trading, because you don't have everyone in the Senate and on the Democratic side on board with all this stuff, and they got to convince some people to do some things to get their votes. And so they need them, because it's not like they have a big majority in either the House or the Senate. And you got everyone running in the House next year, and you got a third of the Senate running. So they all mindful of that when they do things like this. So that's why I think that Trump didn't get everything he wanted either.
Right.
When he got some things, but not everything.
And I think on this, for normal people, what I mean by normal people is, most people don't make over $1 million a year. A lot of our clients do. A lot of people make over $1 million a year. But really, this federal capital gains tax rate applies to people who sell their business. So if you've worked years and years and years, you worked your whole life, and finally you sell your business for $10 million and you can retire. When you start looking at the amount of tax that you pay when you sell your business, it's really stunning. And that's why, if you're going to sell your business, if you know you're going to sell your business in 5 years, you need to start planning that now, because there are a lot of tax strategies you can employ to minimize or mitigate that tax hit when you sell your business. So this is going to apply to people who are selling real estate and realizing a big liquidity event, or selling your business. Less so for people who are making money year over year, because a lot of times I think people don't plan enough, Chris, for the exit from their business. And if you don't plan enough in advance, you end up paying more tax. So anonymous,
Oh, I just want to add one thing. The premise behind always having the capital gains rate being lower than ordinary income too has been, think of a lot of the gains that people have, whether it's in their business or in real estate, is inflation related.
Right.
You know, the property went up just because everything else is going up. You know, business is going up just because so that you buy Apple stock or whatever for this much money, it goes up to this. Not so much inflation related. It's just, it went up, because they can support it with the earnings and everything else. So therefore, maybe that some people would say you could tax those type of things at the higher rate. But if somebody's running a business, worked real hard for a long time, sold for $10 million, they should still stay at the lower rate. Right. Maybe they'll do that. I don't know, because to me, that's a different capital gain than the guy buying Apple stock and keeping it for a year and a day and selling it, and versus a guy running a business forever and ever, and then he sells it for a decent price. But a lot of it is inflation. Same with the property too. You keep a rental house for 2 years. A lot of it's just because the price of everything's gone up, and that's why the house is worth more.
So Anonymous asks, from a tax perspective, would it be better to sell some stock this year versus next year, assuming it would put me over the $400,000 of income plus capital gain? If we knew that the tax rates were going up next year, I would say yes, but the law, it's the same rate next year, right? Under law, right?
Right. But here's the other thing, is on all those things, it's still back to what makes sense financially too. Mm-hmm. Like you look at what stock it is, do you feel comfortable that it's good right now? Is it at the top? Do you feel like where it's at? I'd like to have the tax issues be on the list of why you're doing something, but when it's at the top, a lot of times it's not the right thing to do. It should be on the list, but it's just like buying a vehicle. My response is, do you need it? What kind of vehicle do you want? Not about the taxes. We'll figure out the tax part of it, but figure out what you want. And that's what really, at the end of the day with this stuff, I mean, you're buying stuff that's going, hey, this is all time high. I don't know if it's going any higher right now. I want to take the money off the table. And then you do it, and you don't worry about the taxes part of it, because it's more important to get the thing. Because you see, if the thing drops 35-40% because you left it there, we might as well have sold it and paid the tax.
Right. Anonymous asks, this is related to the Tubbs fire in 2017. I believe this is a question. Do I have justification to have interest or penalties removed regarding the IRS in California after a federal disaster such as the Tubbs fire? I ended up selling my lot. The house burned completely down. I'm sorry to hear that, Anonymous. I ended up selling my lot in 2019 because we couldn't rebuild in a timely manner. I ended up buying another house instead in 2019. My understanding is capital gains are taken when the property is sold. I sold the lot in 2019. That's something that, Anonymous, you should probably reach out to Chris's firm on. It sounds like he would have a loss carry forward. But again, I don't know that there's enough there.
Yeah, I mean, that's stuff that if you have to deal with IRS, it's like you usually start off. It's a long process dealing with them right now because they're short-staffed over there, and I bless them. They're getting inundated with all these amended returns, and I think they're going to finally get some help with some people. I mean, because right now if you got refunds back and you're filing a paper filed copy right now of anything, it takes forever to get back because they don't have the people over there to handle it. And so it can be done. If you're talking about penalties being assessed, and when you're in a national disaster, it's certainly worth requesting a waiver on that. And that would just be a simple letter stating the facts and circumstances, and then you just have to wait it out till somebody actually gets a hold of it and processes it and decides whether they grant you the waiver or not. But it sounds like maybe there's some other things out there that maybe need to be discussed about how this was all handled in the first place.
So there's a talk in the Biden plan about eliminating the step up in basis at death, and it's actually the opposite, a forced realization of gain, which would be a very taxing process, and eliminating the carried interest loophole. So for those of you who are working in companies with carried interest, that would be eliminated, and then caps on deductions for excess business losses. Key takeaway here is consider accelerating income that you would otherwise receive in 2022 in 2021. But again, this is where you need to go through the process to see what's right for you. Anonymous asks, if I sell my rental home for 2.8 million, will I be in the highest capital gains tax rate? Yes. My only income is Social Security. Why do they tax people barely making it by? Well, those are the rules. You can.
Well, they have to tax the masses. That's the thing, is that, what they're doing right now is going to raise some money, but until somebody actually goes ahead and says, I'm going to tax everyone else a lot more money, not just people over 400,000, they're not going to collect any real revenue to cover all the money that's being spent these last, couple of years, on everything else. I mean, they'll just be running a deficit bigger, than we've had. And because there's only so many people out there make, like you said, Jim, some people make over $1 million, but not that many. Really.
Yeah, not that many. Yeah.
And then the same with the estate tax, to drop it down, but is it really going to benefit a lot? I mean, is it really going to bring in a lot of money to Treasury? It's more optics, in my opinion, than anything.
Yeah. Even if they drop the death tax, even if they increase death taxes, people have time to plan for it. So there are a lot of ways around it. And to your point, Chris, it's a lot of optics. So a 1031 is under Internal Revenue Code section 1031. This is where you can sell a piece of investment real estate and buy a like kind exchange. So you can sell an apartment building and buy a commercial building. You can sell a warehouse and buy an apartment building. That is deemed that's a like kind exchange. There is no limit. You can do a tax deferred exchange on $1 billion piece of property and defer your taxes. So there's currently no limit. Biden would limit like kind exchanges. In doing this research, I saw a $500,000 threshold, Chris. I've heard $1 million. Who knows? This is all just kind of plans, but the idea is the first 500 in tax deferred exchange, you can do the tax deferred exchange, but amounts over that would be taxable based on this higher rate. California would likely go along with the federal government on that one because if there's an opportunity to tax something, California's first to the party. So the question about the $2.8 million rental, one thing you could do anonymous is to do a 1031 exchange, and you could defer the taxes. You could do that now. You can do a 1031 exchange into another property. There is also another mechanism where you can do a tax deferred exchange into a professionally managed portfolio of properties. And we do have some videos on our YouTube page about that. And that's something, if you would like to talk about that, you could certainly reach out to our firm and we can connect you with the right people. Anonymous asks, is an installment sale of a single family rental? Okay, is installment sales of single family rentals that have been held for decades with accordingly embedded capital gains, likely in excess of $1 million per property, a viable strategy for minimizing expected increased capital gains tax rates? So an installment sale is where you sell a property and in exchange, you essentially get a note, okay, for a variety of, just the shorthand version, and you pay taxes, you get those payments. So if the tax rates go up, you would be subject to the higher tax rate, right? Because you would be receiving those payments in the future. I would say some of these are listed transactions. There's a variant of the installment note that the IRS is really clamping down on. So I would tread lightly on that, on installment notes. It's easy to screw those up, quite frankly. There are some strategies that the IRS is starting to clamp down on with installment notes. I don't know if you've seen that, Chris, where people will do like a same day installment note and front load the payment. I think that's just a little greedy personally, but
yeah, I mean, I don't mind the traditional, I mean, you look at it, even when a business owner wants to sell the business, one of the questions I always ask is, what are you going to do with the money?
Yeah.
Where are you going to invest it? So if you want to get 5 or 6% from the buyer, the only thing about all that stuff is you got to get enough down so that when the market drops, people aren't just walking away and handing you back the keys in the case of a business or in the case of a rental property. So if you're going to do it, and I do think that's going to be used some this year, if the capital gains rates go up, people will do the installment sales, because then you're only paying taxes as you receive the money over the years. So then you'll probably be under the $1 million in total, and
right.
that'll allow you to pay much less tax. The key is, though, is to make sure you get enough money down, because we know real estate markets are way in a big
right.
time up cycle right now, but we know that that's not going to always be the case.
A reverse 1031 is where you buy the substitute property first, and there's a mechanism to do that. So if you say, gee, I've identified a property but haven't sold mine yet, there's a mechanism to do that. I would say, Anonymous asks, if I have two properties that are $300,000 each and have a zero basis, does the $500,000 limit go to, is it per property or in the aggregate? I'm assuming it's in the aggregate. It's based on the taxpayer, Chris.
That's right. That's right.
What's interesting about that is, does that present opportunities? Could you set up different entities? I mean, this is where, the government passes a law and then the lawyers and accountants kind of figure out ways to kind of chip away at the edges. Just kind of what we do.
Tough to do because the entities are all going to be passed through. So you're going to go
Right.
to you anyway, so
Right.
they make it hard to do that. And you don't want to be a C Corp with any of that, because then you're paying taxes twice. And, so realistically, it's going to be a situation. This year is going to be a tough year for a lot of things, because we're going to do a lot of things blindly, to be honest with you. I mean, there's going to be, we can only do so much. We can just go, hey, maybe this will be the case, maybe it won't. But right now we know things are the way they are. So if, in my opinion, if you're sitting on a rental property and you want to sell it because you just don't want to be a landlord anymore, or you just feel like, I want to get rid of this house. I got a guy over here, he's getting rid of a lot of his older houses because he don't want to fix them up, and he's buying newer ones. And so that's a good move to do on his part. So he's doing it for business purposes, not for really for tax purposes. But I think that you have to look at it and say, just do business the way you would do it, based on what you think is the right thing to do, without taxes involved right now, knowing that we know what the taxes are today.
Terry asks, what are the chances that the SALT limitation will be lifted? What tax software do you use to help clients forecast their tax liability for the year? So SALT caps, I think that we were talking about this in preparation. The New Jersey people, the New Jersey elected officials are really pushing for the SALT cap to get lifted. And that's a state and local tax limitation. What tax software do you use to help clients forecast their tax liability for the year? What do you use, Chris? Are you using Lacert?
We use Lacert. Yeah, it's just like one that most people in our business use. They have a really nice software for planning that we use. We can schedule out years out, and it really is a really cool program, and really useful for us to figure out where we are with years. And of course, they're not updated on anything because they don't know anything right now, as far as they're just doing basically what we got going on right now. So I can't plug in stuff and say, well, what about this rate or this rate? Because they don't even know what it is. I mean, they will do the update once they know what it's going to be.
Jim says, I transferred a rental house that produced income to an irrevocable trust. Should I open an account for the trust, or can I use my individual account to keep track of transactions? Also, the income of the trust is distributed to my kid. He has to report and pay the tax in. I myself don't need to pay taxes, right? I will have zero income as all is distributed to my kid. Jim, it depends on a lot of different factors. That's something we could certainly help you out with. Many times the irrevocable trust that parents make a gift to is a grantor trust, which means that the parent can still be liable for the taxes and the kid gets all the money. It's kind of a weird thing, but it can be very helpful. So, but that's something we could certainly talk to you about. Just go ahead and reach out to us and set up a time to talk. I want to talk about the benefits of an S Corp. And I will tell you, I see this with a lot of clients. And again, this is where people, if you only think about taxes after the year is over, this is something you need to set up. Typically, it's set up at the beginning of the year, January 1 or whenever, maybe mid-year. But it's important to pay attention. And this is not income tax. Now, what we're talking about here is self-employment tax. Now, for those of you who have no idea what self-employment tax is, it's the FICA on your W-2. It's the FICA times 2. Okay. So if a person earns $142,000, it's a 12.4% tax plus 2.9. The employee sees half of this coming off their paycheck. If you're an employer, of course, you have to pay. So if you pay someone $142,000, you're out of pocket more than $142,000 because you have payroll tax to pay. And under the Biden plan, right now, it's capped this 12.4% tax, which I personally believe is horrifically regressive and only applies to people at $142,800 and below. Okay. The Biden plan says that, okay, between $142,800 and $400, there's no 12.4%. But if you go above 400, it's 12.4%. And this, Chris, I don't see this being retroactive because it would totally mess up.
Yeah.
Just this part, I could see prospective, and there is an economic argument to do this, by the way. I would like to see maybe less Social Security tax on people who are making $20,000 a year. I mean, give me a break, right? But that's not our system. Even if you're making $20,000 a year, you're still effectively paying that 15.4% on your.
Well, yeah, not everyone though. Yeah, that's true for most people that don't have kids. But when you have kids, earned income credit comes in and gives that back to you. So a lot of times they're not paying, they're paying it, but they get it back through the earned income credit at that income level. But I think that if this plan goes through, and I think this is one of the ones that has as good a shot as anything to get through this whole plan right here, because it's not going to have enough resistance from people to not, there's no groups or anything like real estate, like the 1031 and the step up in basis, the real estate lobby is going to fight that tooth and nail. No one's going to fight this very much. I mean, it's going to be,
because you'll see it's so complicated. Very few people really understand.
Know about it. Yeah. No, you're right. But it's going to be a big hit to the employee and the business owner. Let's say if you're a business and you got a guy making $1 million W-2, and there's people out there doing that.
Yep.
So right now you pay the 12.4 and the 2.9 on the first 142, but after that you don't pay any more on that. The employee doesn't have that withheld anymore, and the employer doesn't have to pay on that anymore. Now at $1 million, that you get a little gap between 142 and 400 where you don't pay the tax. But at 400 up to $1 million, you got that 12.4 on 600,000, and then the 2.9 as well. The 2.9 is already there anyway, because that's already been law for a long time. But so you add 12.4 times 600,000. What does that end up being? 70 years?
A lot of money. It's like a new Tesla.
Like 70 grand.
Yeah, it's a lot of money.
But it's split up between the employee pays half and then employer pays half. So it's 35 to the employee tax hike for them, and a $35,000 additional deduction or additional expense for the business owner, which he's going to turn around and go, I got to raise my prices. That's what it's going to be. So we're all going to pay it, but it's just going to be through paying more for goods and services that the employer is selling, because he's got to pay those people, the high income earners, more payroll taxes. So that's
the money's got to come from somewhere. So let's look at a business owner with no S Corp. This is somebody who is Schedule C, a business owner who nets $500,000 a year in 2021. The business owner will pay $17,700 in self-employment tax and another $14,000 in Medicare tax. So for a total of $32,000. Under the Biden plan, that jumps to $44,607. So a bit of a bump, a significant bump under Biden. But with an S Corp, if the business owner creates an S Corp, which is a corporation taxed under Subchapter S of the Internal Revenue Code, it's a pass-through entity, so you don't pay tax at the corporate level. The business owner becomes an employee at $100,000 a year. The other $400,000 is paid as a dividend. So the business owner pays 12.4% on the 100,000 and 2.9% on the 100,000. And that's it. So it's 15,000, not 32 or 44. And that's even under the Biden tax act. This is just setting aside income tax. All we're talking is Social Security, Medicare tax. So the benefits of an S Corp is this business owner would be saving $16,000 a year, so almost $17,000 a year. And under Biden would be saving almost $30,000 a year. And I will tell you that the incidence of auditing with a corporation far, far less than if you have a business and put it on your Schedule C on your tax return. So any thoughts on this, Chris? Is this common? Do you see people with this type of a structure doing this, or do they say, no, I'll just pay the extra $14,000 a year or whatever it is? What do you see people doing?
Most people, this is the right way to do business. If you're a small company, small business, medium-sized business, even, family-owned business, S corporation is definitely the way to go. Probably, 90% of the time, and so this is, if you're not an S Corp and you're running a Schedule C as a sole proprietor and you've got a significant business going on, you should definitely take a look at getting incorporated first of all, and then getting it set up correctly with the salaries. And, you got to do some, some reasonable salaries. Don't know if that really is, but you got to do a reasonable salary, and you can make a case with your example there is done quite often.
So Roth conversions, it's something to bear in mind. At least currently at 72, you have minimum distributions from your IRAs, 401k, 403b TSA. I'm presuming that you've retired. If it's not a Roth, okay, you have minimum distribution. If it is a Roth, you have no RMD. So this is very important. This is one reason to do a Roth conversion. And you need to think about is this money, this retirement money that's in your IRA, your 401k, that's not a Roth, it's not entirely yours. Okay. Uncle Sam is a joint tenant on that account. Money is going to be paid in tax. You're either going to pay now or you're going to pay later. And really, we go through an economic analysis. And Chris, we were on the phone last week with some clients. Should these clients, and I want to say it was the IRA was maybe $1.5 million, something like that. Should they do a Roth conversion or not? We ran the numbers, and we were kind of leaning toward perhaps doing the whole Roth this year for a variety of reasons in that case. But it does make sense to consider. And again, this is to consider. I'm not telling you to do anything, but really pay attention to this, because if you want to do a Roth conversion next year, this happens the calendar year that you do it. So this is not something you can do retroactively. So very, very important to understand. Any thoughts on the Roth conversion?
Well, I think it's definitely worth looking at it, but if you have anything significant and you're going to do a significant a conversion, you want to do what we did last week with those guys, right, and sit down and go over it for an hour and a half about the pros and cons and how to structure it right. Because with any Roth conversion, especially anything of significance, you got to have a bucket of money somewhere to pay the tax from somewhere else. You got to have it from somewhere that's not going to be a taxable event also. Like, you don't want to have to sell stock to create more gain to pay taxes for the Roth. And the thing I like doing with the Roth too is finding times when the market's dropped some, dips in the market to do the Roth, because you get to move more stock over at a lesser amount. So that saves you in taxes too. But I think it's definitely going to be something that most people will want to at least consider if they've got a significant Roth. And I'd love, one of the things about paying the taxes, it's also, with getting loans for so cheap right now, you can get a loan for 2-3% to pay the tax. Yeah. And that's a deductible thing, especially you put it on your house or something like that. It does have a lot of relevance, because down the road, if you could have a Roth IRA and not have to see it be taxed, that's going to be a big deal. And I know a lot of people will say to me, well, I think the government's going to change that down the road. It's hard for them. Yeah. I mean, to me, that's a tough one for me to say that they will. They do a lot of things that are like in the middle of the night. I think they changed how Social Security was never supposed to be taxable either, but it is now.
In the middle of the night.
Yeah, they did it in the middle of the night. No one was paying attention. But you never can say never, but chances are I can't see them really being able to change this around. Now, they may get rid of Roths and say you can't do them anymore, but the people that have them already, I'm not sure they can yank the rug from under them. But you never can say never with this stuff.
So Anonymous asks, how likely is step up in basis to be eliminated? And if so, would it be eliminated for the surviving spouse as well as the beneficiaries? I personally think that's not particularly likely. We tried it in the 70s, I believe, for 2 years, and we tried it again in 2010, and it's a big pain in the neck. Any thoughts on eliminating step up in basis?
Yeah, I mean, that's going to have to get through the real estate lobby. I mean, the real estate lobby is going to fight hard on that. So, I mean, it could happen, but I think it's going to be a tougher one than what we were just talking about with this, the Social Security tax going up for people over 400,000. That one would be easier than this one, in my opinion. So this one will be, I think what happens is these guys throw a whole bunch of stuff out there, and then they know they're going to have to give some back. And that's one area they'll go, well, we gave this back for you, so you need to donate a bunch of money to us next time around, type of thing. And so that's kind of a lot of these things are done for those reasons. And I mean, that's just the kind of the skeptic in me, I guess. But it could happen, but I hope it doesn't happen, because that's been a really nice tool for a lot of people to be able to avoid and be able to preserve wealth in the family through generations. But if they get rid of that, it's going to make it difficult to do that. But again, I think the real estate lobby is going to put the kibosh on that.
Anita asks, I have a block. What is SALT? State and local tax. So that is your state income tax and your property taxes. Typically, those are the big ones that you're paying. Marla asks, is there a similar tax saving option for attorneys who can't do an S Corp? Marla, lawyers can do an S Corp. Okay. Lawyers can do an S Corp. So that it's very common for lawyers to have S Corps and for CPAs to have S Corps, correct, Chris?
That's correct. If you're the other thing is, if you're a partners in a law firm or in a CPA firm, the one entity you could also look at that only applies to those two professions, our profession, accounting and legal, is an LLP. An LLP is a nice way. That's how we run our business, and I like it. I like it better than S Corp for a lot of reasons, but not everyone can do it. It's only our business and attorneys. I don't know why that ended up happening that way, but of course you got a bunch of attorneys in Congress, so they want to put that all together. So but they somehow included us in the mix. But that's, in my opinion, if you're partners with somebody, that would be how I'd look at it. But of course, the S Corp wouldn't be bad either for you, but everyone else in S Corp, I think, works really well.
So Anita asks, can you convert a regular IRA to a Roth, and what happens when this happens? Well, it goes from the regular IRA to the Roth, and you pay tax, and your Roth distributions in the future are not taxable, and you don't have a minimum distribution. So the anonymous asks, so the distribution from a Roth is not considered as income for tax. No need to report it on the tax return. Do you report a Roth distribution on a tax return?
Yeah, you still get a 1099 from your the pension company, but it's coded differently so that you show it, but you don't tax it.
Okay.
So it's there.
And then Corazon asks, what is GSTT? We'll get to that. So right now you can leave 11.7 million per person, 23.4 million per couple tax-free in 2021. That is the death tax exemption. So above that, it's taxed at 40%. Biden is proposing a $3.5 million death tax exemption and a 45% tax on amounts over $3.5 million. When the exemption is lowered, the taxes go up. So it's an inverse relationship. More importantly, for many people, the gift tax exemption, it looks like Biden wants to drop that to $1 million. And what that means is if you want to do some advanced planning and shift some wealth to the next generation, right now, the gift tax exemption is 11.7 million and 23.4 million. Biden's proposing to drop that to $1 million. GST is generation skipping transfer tax. Just think the Rockefellers, they say, hey, we're going to game the system. When grandpa dies, he's going to put $1 billion in trust for his son. And so that, and just pay tax at one time. And then when son dies and it goes to the grandson, that $1 billion with a B is not taxed again. The government caught on to that in the 80s and they said, nope, you got to have a generation skipping transfer tax. So you can only put a certain amount of money into a trust that skips the child's estate for tax purposes. If you're following this, you're ready to go to get an LLM in taxation. Many of our wealthier clients use these generation skipping trust, also known as a dynasty trust. And we have a whole webinar on advanced tax strategies. Portability, I would say if you've lost a spouse, we have an upcoming webinar that is, I believe, in the fall, which is financial preparation for the death of a spouse and consequences when one spouse dies first. That does have really an outsized effect. Your income goes down and your taxes go up because you go from being a joint filer to a single filer. And in many instances, your income does drop. You lose typically at least one Social Security check, the lesser of the two. Portability, when a spouse dies, that spouse has an $11.7 million death tax exemption in 2021. The surviving spouse can file a federal death tax return, the estate tax return form 706, and the surviving spouse can actually pick up an extra coupon of 11.7 million. And Chris, I want to talk about this because this is really important. If we end up with a $3.5 million exemption and somebody loses a spouse in 2021 and the estate's $5 million, the surviving spouse really does want to file this portability because that means they get an extra 11.7 million on top of the 3.5 million.
Yeah.
So this is really important. And I would say, when we talk to clients, when one spouse dies, a lot of people, they go, I don't really want to deal with it, whatever. I just think it's a mistake not to do it. And it doesn't even matter what you have. You could have $1 million estate. I think it makes sense to do it because you don't know what your wealth is going to be when you pass away. You don't know what the tax laws are going to be. Do you find when clients have a spouse that passes away, are your clients doing the portability returns or are they ignoring it? What are you seeing in the real world?
No, we have a few of them going right now, actually, in that area. But we always have a few going, but not we don't have it. Thankfully, we don't have a lot of people passing on. But when they do, we do say that this is what you should do. Most of them take us up on it and do it. Some others will do what you said and I don't really care about it, but I think it's going to be more important now with this 3.5,
right?
Because a lot of people are looking at going, I'm never going to get to 23.4 with where I'm at now. And so therefore, like your example of $1 million or $2 million, but now it starts to become more interesting with a 3.5 if it does go to that.
And
so
it could drop in the future. We don't know. I mean, it could not be indexed for inflation and they just leave it. Who knows? Do you have to have earned income to open a Roth IRA? I would say yes, right, Chris? You have to have earned income to open a Roth, unless it's a conversion, a Roth conversion, right?
Yeah, you either have to have earned income or your spouse
Mhm.
has to have earned income. And then if you're over, I think it's like 190,000 adjusted gross, you can't do a new Roth. You can do a conversion, but you can't do a new Roth contribution. But there's ways to get around that. So there's a lot of things what they call as a backdoor Roth IRA contribution, where let's say if your adjusted gross income together, you and your spouse is like 400 grand, you want to do Roth IRAs, but you can't because you make too much money. You can put money into a non-deductible IRA and then transfer it the next day to a Roth. I don't know why they have that, why they just don't let people do a Roth on any amount of income, but you have to go through that whole song and dance to get a Roth still by taking that extra step and first putting it in a non-deductible IRA and then the next day switching it over to a Roth, which seems like a waste of a lot of people's energy to me, but that's what they make you do to do it.
Dana asks, any harm in filing the 706? The government's going to be privy to, you have to list assets on a portability return and essentially estimated values. There's a fee, professional fees associated with it. I think the benefits far outweigh the burdens. Eileen asks, Chris, can you convert a Sep Ira to a Roth?
Yes. Okay. Same rules.
Anonymous asks, my mother-in-law passed away in January of 2021, and she had her home in a trust. We're selling her home now in the name of the trust as it's easier than transferring the title to the two beneficiaries. It will be a loss because of selling fees. Does the loss flow through to the beneficiaries on their K-1? If it's a primary home, does the losses not flow through on a 1041?
They do.
They do. Okay, good.
Yep. Because it wasn't their house, it wasn't the beneficiary's house, it's their mother's. And so they're just administering the trust. And that happens quite a bit because you put the value out there, you get the value at the date of death, and you sell it for the same amount or close to it, but you got all these realtor costs that create this loss.
Subda asks, can you contribute to Roth and Roth conversion in the same year if you qualify? I think so. I don't think there's a...
You can do both the same year.
So here's how Biden taxes $100 million estate. This is because the numbers are easy. What they're going to do, by the way, this is this is federal only, not state. But if this becomes law, you can bet that California is going to jump on the bandwagon on that one, even though we have a proposition that amended our California Constitution where California cannot impose a death tax. This isn't exactly a death tax. This is realization of gain. So I think they might be able to sneak it in there. Basically, they make you realize all your gains. So assume $100 million estate with a zero cost basis, forced realization of gain, $43 million in tax, 56 million is left over, $3.5 million exemption. The tax is 45% on top of on the 53. And that makes your death taxes 23 million. So in this case, it's an effective 63.7% tax rate. For Californians, add 13.3. It gets over 80%. Very depressing. There are well-established strategies at wealthy families, that is over 3.5 million in wealth, used to minimize income taxes, capital gains taxes, gift taxes, property taxes, death taxes, and generation skipping transfer taxes. Yes, it is true, Chris, rich people, as we know, they pay less tax because they do three things. They hire the best advisors. They hire you, they hire me, they hire people like us. They take their advice. And as you indicated, Chris, on the Roth conversion, they have capital they can deploy strategically. So you need that capital. And so this is when your grandparents and parents said, always save some money every month. I wish I would have listened to them more when I was younger because I would have more personal savings. But my point is, there's a lot of flexibility. You can do a lot of things if you have capital, right? If you've got the dollars. So who should do what and when? I would say get your team together. This year really is important, more important than many other years, but I would assemble your team if you're going to do some of these planning strategies. I know, Chris, you're busy. I know our firm is getting busier. If you're a business owner or have more than 2 million in net worth, and this includes home rentals, commercial, industrial, IRAs, death benefits on life insurance, I would counsel you to seek advice in 2021, because if you wait till 2022, it might be too late. So this is what we covered today. We covered, well, are the taxes retroactive? Probably not. PPP forgiveness. Should you move income to 2022 or from 2022 to 2021? Are 1031s going away? Probably not, but maybe benefits of an S Corp, Roth conversion, and of course the death taxes. this is how you contact, you go to the Munn firm, it's muncpas.com. And you can see that up there on the left-hand side, and you can click contact us, and you can go to our website as well to book a consultation. So we have a few more questions. I will open it up. Whoops.
You know, Jim, one more thing
yeah.
I had just to go back a little bit on the government stimulus. If
Yeah.
if you're a business owner and you got employees for 2020 and 2021, and you haven't spoken to anyone, the people that you're working with to doing the taxes or legal haven't talked to you about these credits, there's money out there probably for you, because most people in California were at least partially shut down. If you weren't fully shut down, there was a period of time where nobody could really work for a few weeks. I know back in March and April, and even though, you know, we had to be limited in what we could do. And so you may qualify, and you may think I don't, or somebody maybe told you didn't, but you may want to take a second look at that, because some of these credits can be pretty substantial that you might be missing out on.
Anonymous asks, any update on California property tax bills, Assembly Constitutional Amendment 9 and SB 668? Nope. They're scheduled for additional hearing. That was May on the SB 668. There's no date set. We're planning internally in our law firm for SB 668 to pass in the fall. That's internally, we're preparing for that and the work associated with that, because we were very busy with Prop 19. Marla asks, how likely do you think it is that forced realization of capital gains at death will be implemented? I don't know. What do you think, Chris?
I don't think so. I just think it's going to be difficult for them to get that one through. That one would be lower on my list. Not to, never can say never, but I wouldn't count on that one. There's other ones that I would definitely put way ahead of that one.
All right. Well, Chris, thank you so much. This has been great. Thank you for attending today. Subscribe to our YouTube page, and we'll see you next Thursday.
Sounds good. Thanks for having me.
All right. Good to see you.
Take care. Bye-bye.